Good morning, Yanchu. Was it Janet? I'm sorry, who said, oh, Yanchu, yeah. How are you? So it looks like
I'm
we
doing good.
are
Thank you.
good, good.
Good
Good morning,
morning.
Janet. Good morning. So we're just getting started, right? We're just getting started. Let me check. So looks like there are 5 people and in the discussion board. So I'm expecting at least 2 more people to join us. Now, and pretty much, let me just bring you up to date or bring you up to speed. So, announcement, in the announcement, you may have noticed that, uh, the final went out. The information about the final went out. Okay. I have, fnb 300 spring 22 online. And final instruction went out today, right? Uh, and the face-to-face day. Well, we have to have it. We can't avoid it. For me, it's a hassle to actually. Um, and I don't expect anybody to be there because it's Saturday morning. Although I'm going to have to start at 11 because it's a hassle for me to get there. But then if you have again, if you have been attending all these sessions without any gap, right? So you made no absence. At least you're entitled to 1 day of absence, don't you think? And you can exercise that. You can exercise that entitlement on coming Saturday. I mean, on the 11th. But either way, I'll have to be there. But if you show up, then yeah, I'll be in Murray Building 1009. I'll have to check, if that room is a smart classroom. I guess most, at least, um, it's all smart classroom at BMCC. Um, so that's it. And also, you may have noticed, if you go to the assignment, there is, midterm quiz to quiz one, midterm quiz to results. The most recent, the latest summary statistics. So if you open it, maybe I need to. Maybe this is not the latest one, but if you open that, you'll find. Was it here? Where did I put it? Oh, so obviously this is not the one. This is not the. So let me go to. Documents. Okay, I think this is the latest one. I'm going to copy that. Paste. Let me open it from there. Okay, so of course it's anonymous, and by listed by your student ID in the descending order, right? In the descending order, your attendance and participation is all here. I mean, this is the your attendance and participation combined. Okay. So when you open it, it may not be exactly like this because the old version didn't contain this, but this is not important. So I'm going to update that later if it is not the latest version. All right. All righty, going back to then. Let me see how many people. All right, we have like 9 people. So let's see how many are here. We have 6, so still, 3 more people need to join. All right. So in the last class, we were talking about the capital components, right? And so let me open whiteboard. So it's been like 2 weeks since our last class. So, obviously you don't have, okay, I'll just keep writing on this. All right. So, where's my pen? So we know we have 3 different sources of capital or 3 capital components, right? Equity breaks down into 2 categories: common stock and preferred stock, right? So and then debt, right? So the cost of capital of common stock is called KE, cost of equity. And then the cost of capital to the preferred stock is called KP, cost of preferred stock. And of course, cost of capital to debt is called KD, right? Oh, no. Okay, make that smaller. And then now 100% again. And then these are basically capital components. And we know what capital structure is. Capital structure means, basically, the composition of these assets, these capital components, by their weight, out of the total capital. And once again, I've been telling you, total capital and total assets are not the same, right? Because capital means always long-term capital. Capital means long-term capital. Like, equity and debt, long-term debt, not the current liabilities. So we know um, total asset is greater than total capital, right? Because it's greater than total capital by as much as current liabilities, right? So we are only talking about the long-term debt, right? Equity and long-term debt. And let's say, the percentage can be whatever, but the percentage is the weight. So we call this weight of equity, weight of preferred stock, and weight of debt. So that brings us to the conclusion that then cost of capital, overall cost of capital is basically what we call weighted average cost of capital. And then weighted average cost of capital is all of those cost of capital components weighted by their weight, right? So weight of equity multiplied by cost of equity plus weight of preferred stock multiplied by cost of preferred stock plus weight of debt multiplied by cost of debt, right? Or we can also express this as weight of I times cost of I, where I runs from, whatever, because there are three capital components, right? We can write it like this, or we can also say, or where where is E P D. Okay, is everyone okay with that? This is how you express it without being, think about it. You're finance majors. Then if you're finance majors, you should be able to express it like this instead of using words, right? Rather than using words, weighted average cost of capital is blah, blah, blah. I just can't express it in words, that words are just, words are dumb, right? Words are what, only, elementary school kids use to express ideas. But, complex ideas like this, it's going to be very inefficient if you explain it in words. Okay? So, and we understand, cost of equity is the highest, and then cost of preferred stock is the next, cost of debt is the lowest. In other words, think about it. You borrow money from the bank, or the interest rate is the lowest, right? But it's guaranteed, right? You put money in the bank, you get interest, but that's the lowest riskless return you'll ever get. Lowest riskless return, right? And as it but if you put your money into stock, there's no guarantee, right? You can lose it all, right? Over the last couple of weeks, I just checked, my portfolio was at its highest on November 17th, and since then, I lost almost 5%. But that's how it has, for the last since the outbreak of the Omicron variant, the market has overreacted, and then almost lost 5%, which is think about it. If you have $1 million in your portfolio, you lost $5 million just over the course of a couple of. Or if you have $500,000, you lost 25K just over past couple of days. And they're even saying Omicron is more, I mean, in terms of its spread, power to spread, it's more powerful. It spreads more easily and widely, but its intensity is much lower. It's just like common cold. And the scientists, must be biologists and all these virologists and they say the virus evolves in the way that is best for their own survival. So if the virus is too strong, then the host dies quickly. And if the host dies quickly, they die too. So they decided, as if the virus has some kind of collective intelligence. The Omicron variant evolved in the way that it can, it can be more contagious, because then moving from one host to another, it increases its chances of survival. And if they are too strong, their host dies too quickly. So that lowers their chances of survival. So they evolved to become weaker. Can you believe that? I mean, that's even the virus has some intelligence. Of course, without intelligence, they just I think that's the natural selection. The ones that are too strong just cannot survive because the host dies quickly. But the ones that are weak, then they survive. So anyway, let's take a look at this example. Calculate the weighted average cost of capital for Zodiac Company given the following information about its capital structure. So their capital structure is, like 9% debt, 11% preferred stock, 14% common stock. Yeah, this percentages came from 60K over 200K, right? 50K over 200K, 90K over 200K. Then, if this is their first calculate, so we got that. So then, I'm sorry, that's the cost of capital, not the weight, I thought. We find the weight. Weight is, 60K over 200K, 50K over 200K, 90K over 200K. And then the weights are 30%, 25, 45, right? These cost of capital were given, cost of debt, preferred stock, and common stock were given, but more advanced problem, then they will make you find cost of capital. So you will need to calculate it from the given conditions, but this is just basic example, so it's given. And it's it's easy. It's weight times capital component, right? exactly as I said, weight times capital component, weight times capital component, weight times capital component, right? Therefore, this times this, 2.7, this times this times this, and you add them up, the sum, right? That's weighted average cost of capital, 11.75. Okay. And then, so we know what capital structure means, this is the capital structure, right? This is the capital structure, right? This is the capital structure. So, but then the thing is, the problem is, what do we use as the capital structure? I mean, there are two, you all understand, two different values of these capital components, right? Two different ways to value these capital components. One is book value and the other one is market value. The answer is the market value, of course, because market value is the reality. And I've been telling you, book value is always past data, book value no matter what, right? Because the books are, how often are the financial statements updated? When I say books, that means financial statements. So how often are the books updated? Anyone?
Quarterly?
Yeah, quarterly. Who said that? Quarterly. Who said it?
Anna?
Anna?
Yeah.
Okay, Anna. Yes, you're right. Anna, you got 0.25. Yes, of course. So, yeah, the books are updated quarterly. So, think about it. We are almost uh, going towards the end of the fourth quarter of 2021. December has already started, right? So we are in the tail end of the fourth quarter. But the latest data we have is as of the third quarter, end of the third quarter, right? And we'll get the fourth quarter data only in January of next year. So obviously, when we got our third quarter data, that was at the beginning of October. But how far have we moved from October, right? We have moved 2 months, from October. So the book value is already passed. And since then, our asset values, market value of our assets, have moved on, right? That's why we cannot rely on the book value, although that's the most recent solid data. For the solid data, for these actual solid data, right? That's the most recent one. The market value changes constantly. So if I raise my voice just a little, then my head is pounding like as if I'm having a concussion. So I shouldn't even raise my voice. So even if I speak, quietly, I hope you would all, pay attention. And so, yeah, that's why we have to use market value to calculate our capital structure, right? So weighted average cost of capital to evaluate next year's capital projects must be supported by capital raised next year. In other words, yes, next year hasn't come yet, but if we have a project, right, planned for next year, then it's only right, and it only makes sense to use the projected capital structure. In other words, projected, right? Predicted capital structure for next year. So we'll have to then how do we? We'll have to make forecast of all the asset values, all the capital components, value of capital components, right? Forecast for next year, and then make use the capital structure based on that. And book values reflect capital raised and spent years ago, right? Current market values represent our best estimate of the next year's, capital market conditions. So market values are the appropriate basis for weighted average cost of capital for two purposes, right? For two reasons, for capital structure and for component cost. Also, component cost means KE, KP, right? KD. As for the capital structure, assume the firm will either maintain the present capital structure based on the current market prices, right? Or strive to achieve some target structure, either the market capital structure based on the market value, or strive to achieve some target structure. There's a reason that the companies will try to adjust their capital structure. And the main reason is for the stock price, right? To increase the stock price, they change the capital structure. Okay. And together with also the earnings per share will to increase earnings per share, right? They adjust the capital structure, and they adjust it to match the target capital structure. And if you reach the target capital structure, then your earnings per share of your stocks, earnings per share will go up, and therefore a stock price will go up. Now, so first, let's think about market-based component cost. Use step 1, develop a market-based capital structure. Step 2, adjust market returns on underlying securities to reflect the cost of 3 capital components. Yeah. And step 3, combine the cost of capital components in calculating weighted average cost of capital. So here, here's the example. The Wachusett Corporation has the following capital situation. They have $2,000 only. Actually, it's like everything is in thousand, right? Normally they scale it down by thousands. So what this means, would be like 2 million, right? So never mind, we'll just call it $2,000 in bond. $2,000 bonds were issued 5 years ago at coupon rate of 12%. They had 30-year terms and $1,000 face value. They are selling to yield 10%. Now, in Finance 100, if you have taken 100 with me, you've heard this over and over. This is the way it is worded. They never say straightforward, use 10% as the discount rate. They never say that. And the way the discount rate is worded is the bond is priced to yield. The bond is priced to yield 10%, or similar bonds or comparable bonds are paying 10%, or the prevailing market rate is 10%. Okay, please remember this. Okay, the problems there is no such problem. I haven't seen any problem that says straightforward that this is the discount rate. Use this. No, they will never say that. Okay, it will always be worded this way. So then we can. That means uh, with the with this, we can calculate the current market price. Oh, this is not $2,000 bonds. Actually, 2,000 bonds, 2,000 issues of bonds, 2,000, I see, 2,000. So, issued 5 years. So now this gives us, how to find the bond price, right? This will help us calculate the bond price and market value of the bond, right? It's more actually intrinsic value of the bond, and assuming that the market price is equal to the intrinsic price, intrinsic value, and that times 2,000 will give us. It will give us, right? Uh, uh, it will give us, our value of our debt. Okay. Second, preferred stock. 4,000 shares of preferred stock are outstanding, each of which pays an annual dividend of $7.50. Excuse me. They originally sold to yield 15% of their $50 face value. They are now selling to yield 13%. Okay, so what does this mean? Preferred stocks are perpetuities, and you know how to calculate perpetuities. That's what we did in Finance 100, right? We use constant dividend model or zero growth model because it's a perpetuity, which means it pays constant dividend. It doesn't. So how you value the perpetuity is dividend over R, right? And we already know dividend is like 750. It's constant, right? And the currently it's priced to yield 13%, right? You can get, look, originally it was 15% of their $50 face value. Then try this: 15 times 50, 15% times 50. That's why it is 750. And if the face value is if the $50 is the face value of this stock, right? But that current market price is different. When it was initially issued, right? Face value is $50. This is something interesting. Common stocks don't have any face value, because that's what the common stocks are. The price depends on the market. The price of the common stock depends on the demand and supply. Although common stocks also do have par value. Par value is, you might say, isn't par value the same thing as face value? In case of bond, yes, but in case of stock, it's meaningless. In case of common stock, right? Par value means, for common stock, it's nothing but IPO price at IPO. So common stocks don't have any face value written on it, right? And IPO, the stock sold, most recent IPO was what? Have you guys heard of a company called Rivian? Anybody heard of Rivian? No? No one heard of Rivian? Rivian is a electric vehicle company. So here's the thing, you know Tesla, but there are other electrical vehicle companies. There's Nikola. Nikola is the first name of Tesla. Anyone ever heard of Nikola? Because Nikola Tesla was the guy, the genius. And he was actually more genius than Edison. Edison wasn't, as he said, 1% inspiration and 99% sweat. Edison, but Tesla was really a genius. So that's why Elon Musk named this company Tesla. But then there is a company called Nikola, which is basically specializing in electric vehicle. Electric truck. Electric trucks only. And then there is also a company called Lordstown. And Lordstown is like, mainly doing, pickup trucks and SUVs, I believe. And Nikola is, for making big trucks. But, none of these companies ever came up with any actual product. They are like, the early stage of Tesla. They haven't put out any, other than the prototypes, right? And Rivian is the new company, which is mainly, I believe, also specializing in pickup trucks and SUVs. So they are not in direct competition with Tesla. And there is another company, I think, Polestar. So Rivian is the most recent IPO. They went public, right? Anybody ever? I don't think you did. Polestar, I think, so they are all startups. Polestar hasn't gone even public yet. And so Rivian is quite new. It's not even 1 month old, probably 3 weeks since IPO, 3-4 weeks since IPO. And at the time when the IPO price was only about $75, and then it went up to almost like 200. Let me just quickly check. It's not really my holdings. I just put it under, Rivian. Here it is. I didn't buy this company because primary IPO is always primary market. And the primary market, you're not invited. Individual investors are not invited. It's invitation. It's on invitation only, and yeah. So it was invitation only, right? So think about it. It went public on November 10th. And it started out at, this was IPO price was, so that's the end of the day price, I believe. IPO price was like 75, and then that's the par value of the stock. And then it ended on that day, looks like 104 on that day. And then, so because I'm not an institutional investor or a huge, investor with huge, capital, uh, no IPO. But then to buy it in the secondary market, it was too late because the next day went up to 122, and then 172, right? 123, and back down to buy, So it's been like how many days? Almost, just about, 23 days, right? 23 days. And then, it's back to where it began, almost where it began, right? These are trading volumes. Volumes are also important because uh, even though there are price movements, if the volume is weak, then it's not a really driving force. But on the first day, IPO day, right? Volume was like that's the price, but the volume was like what? Uh, how many? The latest volume, even the latest volume was like 13.8 million shares traded, and this must have been at least six, seven times that. But anyway, um, common stocks don't have any face value, right? Um, Common stocks don't have any face value, although they have par value, but the par value is just the IPO price. Okay. Um, we can find the preferred stock price, and then we just multiply it by 4,000. Equity. What you said has 200,000 shares of common stock outstanding, currently selling at $15 per share. Well, we'll have the market price for that, so we simply need to multiply this by 200,000. So develop Wachuset's market value based capital structure. So okay, um, so what we need to do is we find the so here everything is um, so let me. So we'll need to find the value of debt, value of preferred stock, and value of common stock. And we already know this. There are 200,000 shares, and they are selling for how much? In the market, they're selling for how much? Wasn't it $15? Okay. And value of preferred stock, we already know is $15, right? Over 0.13 times how many shares? How many shares are there? 4,000 shares, right? And value of debt, the bond price, right? We know the bond price, how to value bond price is, payment. First, present value of all those coupon payments, right? R times 1 plus R raised to N plus the maturity value or the face value of the bond, which is $1,000, 1 plus R to the N. And then this is the price of a single bond. So we multiply it by how many bonds are there? Like 2,000, I remember. We only need to do this, right? And then just let me make, I'll just make sure if I got the correct data. Okay. Oh, I'm sorry, that was 750. And then 30 years, right? 2005 years. So it was issued 5 years ago, 30-year term, so 30 years to maturity. So we have 25 years left. Currently, we have 25 years left. Discount rate is 10%, and coupon rate is 12%. So let's organize this. And first, this wasn't, I'm sorry, this wasn't $15, but $750. This was $7.5. Now, N, so discount rate is 5%. Why? Wasn't it 10%? Yes, 10% is annual, right? But bond is on semi-annual cycle. Bond is on semi-annual cycle. You remember that? Bond pays coupons, semi-annually. So, and so bond pays, it's a 12% coupon, right? So 12% annually. So every 6 months, semi-annually, 6%. So this is $60, right? And then we have 25 years left. So N is 50 because there will be 25 years means 50 semesters, right? 50 semesters. So once we have all of this, then we can solve. So, but if you have set it up like this, then we'll use Excel to solve, right? So here, I have a very long. Yeah. This is actually, that example 13, example 13.3. This is 13.3, right? Yeah, 13.3. So let's do this. What's that? I want you to open this file, right? I want you to open this file, and of course, then you will need to other than the and then all the highlighted cells I want you to clear out. All the highlighted cells I want you to clear out. Okay. Okay, I want you to clear out all the highlighted cells. And of course, I will make a slight change because this is, we have bond, preferred stock here, but no common stock. I will change this to let me call this, okay. Maybe no. All right. Do you have this file in front of you, everyone?
Professor, is it the
Got it.
cost
The
of
file
K
name,
or cost of K Excel?
what?
Cost of K Excel, right?
Yeah, I think, let me just go into the, yeah, okay, yeah, it must be. Yeah, that's cost of KXL, but that file, actually, the file would contain a lot of, you see, it would be the same file that contains, this, right?
Okay.
So you need to be on the right, worksheet, right? Okay. And so clear out all the highlighted cells. Okay, clear out all the and if you have it in front of you, just get ready for this exercise because I think this is it's gonna take some time. So we have I think we better do this after the break. So just get it prepped. In other words, delete all the highlighted cells and get it. So it's 10:27 already. So I think it's the right time to take a break. So we'll take a 10-minute break and reconvene at like 10:40, right? And then we're gonna do this, okay? Which is not a difficult thing, but all right. Okay, so 10-minute break, and we'll see you at 10:40. All right, we're back. We're back. So let's do this one, right? Let's do, everything is all set up. And you are using basically my template, but you should be able to build this one on your own. You should be able to build something like this on your own. Uh, Now, first, let's find the market price of the bond, right? So first, we will need to find the present value of all those annuities, the coupon payments, right? So, which is, that, right? $60 over cost of debt, which is, 10% divided by, 2, right? Minus payment over or payment over R times 1 plus R raised to N plus parenthesis. That's the coupon, present value of all those coupons only, right? And then, of course, we know how we got these numbers, right? Because, and then present value of that face value, $1,000 face value. It's easy, nothing but. And then 1 plus this raised to N. All right. And then think about it. It's paying very higher than this bond is paying higher than uh, the prevailing market rate. Prevailing market rate is 10%. Coupon rate is 12%. So obviously this will be a premium bond. It will sell at premium, right, above par value. And then, $1,000 to receive 20 years later means only, $87 today. It's only worth, but anyway, we sum these two numbers, right? And then that's the price of the bond, okay? Let's find the price of the preferred stock, which is simply this divided by this. And the market price of the common stock is already given, right? That's why I even removed the highlight there, because it was already given data. And then all you need to do is then, market value of 2,000 bonds outstanding, which is, then this times this. Right? Also, it is, this times this. Right? Also, this is, this times this. Okay? And I will use auto sum to sum everything. Actually, auto sum won't work here because it's not, the data range is not contiguous, meaning, it isn't without any gap. But, if you highlight all of them, right, this plus this plus this, right, it's going to be J17 through J23, the weight, then, it is this divided by this. And I'm going to lock, by hitting F4, I'm going to lock the denominator. Then that way I can copy. Okay, It's also doing the yeah, just it's highlighting. It's like merging all the cells. So instead of, I'll just do. Okay. And this one I can lock. Hit F4. Then I can copy. And then this too. Of course, it has to be 100%. I don't like to lose, formatting. Keeping it neat, the border lines, they need to be. Okay, so we found the weights. Then, the next question is then the cost of capital. And we have cost of, weighted average cost of capital. We have cost of debt given, but cost of preferred stock given. Maybe I should. We just don't know cost of equity. You just don't know cost of equity. We'll need to find it. But the problem was only asking only up to this. So the weight, 42.27, 4.12, 53.61. Let's see if we got, yeah, 42.3, 4.1, 53. So, and then calculating component cost of capital. Begin with market return received by new investors in each capital component. Make adjustments for tax effects and transaction cost to arrive at cost to the issuing firm. Yeah. For example, cost of debt. The interest cost of debt is basically, interest the company pays to the bondholders, right? Cost of debt is the interest rate that the bond company pays. So the interest rate times, total amount of debt is of course the interest in dollars. That's the interest payment to the company. But then we know interest is tax deductible. Interest, because interest payment is a business expense to the company, and we talked about this in the financial statements a lot. So it is tax deductible. In other words, what it means is, think about it. What it means we all know, I mean, I don't want to go back to the income statement, but what can I do? So you all know back to the income statement. Primary source of income is sales revenue, right? And then secondary source of income is investment income, which is passive income. And expenses, right? Primary source of expense is CGS, cost of goods sold. Secondary source of expense is operating expenses, right? And then when you subtract expenses from income, then it's EBIT, right? Also called operating profit or operating income, right? And then from there, you pay interest, right? Because it's EBIT, you pay interest. Now think about it. Suppose this interest was, 1 million. Right? Let's just say 1 million, right? And then your EBT, subtract interest, EBT will be, less by 1 million. It's less than EBIT by 1 million. And then, so suppose this was, 5 million, right? If this was 5 million and interest is one, so we know EBT, taxable income, or, let me, another name for that is taxable income. This would be 4 million. Now, then you pay taxes, right? Of course, then comes the taxes, which is, let's say it is, at 30%, right? Then it will be, 30% of that, 4 times 4, 1.2 million. But think about it. If there was no interest, if this was zero, right? If this was $0, why? Well, first of all, if there was no debt, if there was no debt, then there will be no interest. Then, if that was the case, the taxable income would have been 5 million, right? The taxable 5 million, right? This doesn't look like 5 million. You would have paid more taxes, and the taxes would have been 1.5 million. The taxes would have been 1.5 million, right? You get it? So in other words, as much as the tax rate, right? As much as the tax rate, you are saving on taxes because of interest, right? You're saving on taxes because of interest. In other words, yeah, because it's business expense, right? So that's called, a tax shelter, or, tax shelter, but tax shield. I mean, not shelter, tax shield, right? Interest has a tax shield, and so effectively, if the interest rate is, in this case, if it is 1 million interest rate, that means interest rate is 20%. Isn't that right? Interest rate is 20%. So because of the tax shield, the net effect, your so cost of debt is effectively less by the tax rate, exactly. So in other words, effectively, although you're paying $1 million in interest, but since it saves tax by 30%, so you're effectively is 0.2 times. So in this case, this is 0.2 times 1 minus 0.3, right? So it's actually, 0.2 times 0.7, 0.14, right? 14%. Your, effective tax rate, effective interest rate is 14%, not 20%. Okay, that's, oops. That's why, we need to make that adjustment. That's why interest as a tax shield, because it is, business expense, right? So tax shield. That's why we need to make adjustment, right? Make sense, right? And then for stocks, there is, we have to consider the flotation cost. Flotation means, float. You have to make announcement, right? When you are selling stock, there will be you have to make announcement, that. So it would have to be on the newspaper or print media or online media or on TV, radio. They have to, you have to advertise sale of stock, and then you have to print the stock, right? And then brokerage fee, things like that. That's called flotation cost, right? So we call that F for flotation cost is a percentage. So apply to preferred and new sale of common stock, and it increases effective cost. Yeah, think about it. Cost of preferred stock, or cost of equity must be adjusted by 1 minus flotation cost, right? And then, because the denominator gets smaller, then the whole fraction gets bigger. So cost becomes, bigger. In other words, now think about it. Cost of equity is not something that the company really pays. right? Cost of equity is not something that the company pays to the investors, right? On the other hand, I've been telling you over and over, investors recoup their return, recoup their profit by selling the stock, right? So when they say the return is, return is 15%, that's the result of selling the stock, and you did by calculating the return, which is think about it. How do you calculate return? Of course, holding period return is Pn minus P0, price at time n when you sell it, price at time 0, that's the price when you bought it, and plus sum of all the additional cash flows divided by P0. And in case of stock, this cash flow is dividend, right? But between time 0 and time n, that could be any number of years or any number of months. That's what is that's basically holding period. But if we scale it down to a single period return, so single period, let's say 1 quarter. If you were holding this stock for 1 quarter, right? Then the return at time t, right, is price at time t minus price at time t minus 1. And between t and t minus 1, it's 1 quarter. Plus, and during this 1 quarter, there can be only one dividend payment, which could be, which could be greater than or equal to 0, right? Dividend can be, sometimes they don't pay any dividends, right? Divided by P sub t minus 1, right? Makes sense? But what I was saying was that the return cost of equity is the return, right? And basically these guys are what you call cost of equity. Of course, holding period return must be like annualized, right? Also, this, a single period return must be annualized too, right? And once annualized, then it must be the same number. And then think about it. This must so cost of equity is the required return, and I talked about this in the last class as well. This is the required return. Cost of equity is the required return, meaning where do I write it? And what is required return? That's basically the hurdle rate. Hurdle rate means you have to clear that hurdle. In other words, that's the bottom line that the investors the stockholders want, right? That's the bottom line that the investors require. But how do you know what's the bottom line? How do you know what's the bottom line? Huh? How do you know? Have you taken a survey? Have you polled everybody, every Apple shareholder? I mean, Apple shareholder is global. There will be like, tens of, hundreds of thousands of shareholders of Apple, both institutional and individual, maybe millions. And how would you take a survey and you ask, you pass around the questionnaire, what do you want, what do you require? I mean, what do you want for return? What do you require? I mean, do you think they have passed around the survey and collected the responses? And, uh, that's obviously not possible, right? Unthinkable. I mean, you can't, and you don't know who are at, because shareholders are anonymous. I told you I'm an Apple shareholder. I don't know how many shares, and I'll probably know 20 shares, 50 shares, maybe 50 shares. But I would be a minority shareholder. I'll be a minority shareholder. They don't know. They don't even. They don't care about the minority shareholders, right? Um, so there's no way they will take a survey, and based on that survey, they determine. No, it's not like that. Um, Again, then, uh, how do you find required return? Required return is so then required return is determined by CAPM, capital asset pricing model, CAPM, right? Capital asset pricing model. So again, you did this in Finance 100. If you, at least in my class, in the classes that I teach, we cover this. CAPM, capital asset pricing, and I always tell the students that the CAPM is a misnomer, a little misnomer. Why? Because they think, CAPM gives you the price because it says capital asset pricing model. No, it doesn't give you the price. This is a model to find the required return. Okay, it's the model to find that required return. So this gives you that required return. Okay, and that means, the stock's actual return or the stock's expected return must be at least the stock's expected return must be at least equal to or greater than the required return. Okay, if the expected return is less than the required return, and there's no point in buying. Investors would not buy that stock. They will not hold that stock, right? Because it's not even giving you the required return. Okay. So that's why I've been telling you, company doesn't pay out the cost of equity or the required return to the stockholders. Stockholders will recoup it when they sell, right? So the expected return must be greater than the required return for the investors to hold that stock, right? Makes sense? But then that also means with the flotation cost, right? Adjusted for flotation cost, the cost of equity must be greater than without adjusting, right? Without adjustment, because the denominator is smaller, KP and KE will come out greater. Okay, so here, let's take a look at this example. Blackstone Inc. has 12% coupon rate bonds outstanding that yield 8%. Now, I've been telling you, if it says it's price to yield, or it yields 8%, that means this is the discount rate, and this is the coupon rate, and this is not this. And another thing is, this is not the bond of this company, right? Think about it. You cannot hold your own bond because bond is a debt, right? You sell the bond, someone else holds it. So if Blackstone holds this bond, it's someone else's bond, some other company's bond. You understand? I mean, if you cannot construct a story like this, then you learned nothing. That means spend a futile effort all this time. If you think, oh, that must be their bond. No, it's not their own bond. Their own bond is held by somebody else. And this is the bond they hold of somebody else, right? No, I'm sorry. I'm sorry. This is their own bond. I got so it's because this was wrong. It shouldn't say holds, because if you say hold, you're holding somebody else's bond. You invested in somebody. This is wrong. I don't know why hold is there. It means they sold. Actually they sold. It should be they sold, right? I should change this. They sold 12% and then a part of their capital structure is bond, right? And Blackstone's marginal tax rate, including federal and state taxes, is 37%. What is the Blackstone's cost of adjusted? In other words, adjusted cost of debt. So their cost of debt is 8%. I said this is the discount rate. So adjusting for tax, right? And it's 8% times 1 minus 0.37, so it comes to 5.04%. That's the adjusted, right? So I should change this. I don't know how. It must mean, sold, not whole, sold. And it's a different company. Preferred stock of Francis Corporation was issued several years ago, paying 6% of a $100 par value. So dividend that means dividend is $60, right? Dividend $60. Flotation cost are expected to average 11% of the funds raised. What is the cost of preferred if return on similar issue is now 9%? This means this is the discount rate. Okay. The cost of preferred stock on the similar issue is now 9%, right? So then we need to adjust it by the flotation cost, right? Calculate the cost of preferred if the shares are selling at 75. If the shares are selling at 75, right? uh, the cost of preferred must be lower what was originally 6% for the same. So $60 must sell for 75 now. What was originally the only way it can be is, so we'll find. Um, so A and B ask basically the same question with the different given information. In A, the market return, or K, and in B, in the price information. So we make adjustment, 9% over 1 minus 0.11, right? 0.11 is the flotation cost, so 10.1, right? And then 6% of 100, I'm sorry, $6. So then for this to be before adjustment, it was 9%, right? Before adjustment. So think about it. The math is simply, right? The price of the preferred stock. Actually, I reserve the symbol V for aggregate value, total value. In other words, a single. That means value of all preferred stock, meaning okay. So usually V is the symbol reserved for the aggregate amount. But sometimes they use it interchangeably. But I reserve that for aggregate, and this is single stock, price of a single stock, right? So well, so I will use this symbol. So think about it. Price of the stock, preferred stock, is dividend over KP, right? And then dividend is $6, right? And then what should be the KP? And it is now selling for 75, it said. Right? Wasn't it? Cost. If shares are selling at 75, then of course, then KP must be 6 over 75. Okay. Then of course, you can quickly %, not 9%. Oh, yeah. I mean, after adjusting for, so let me do again, clear. 6 divided by 1 minus 0.11. That was the flotation cost, right? Times 75. Yeah, it comes to almost 9%, right? Comes to 9%. So and then cost of common stock. Cost of common stock is not precise due to the uncertainty of course, future cash flows. That's why we are only, all these are intrinsic values that are based on the discounted value of the future cash flows. We use CAPM to find the discount rate, and then we use golden growth model to price it. Okay, and also the risk premium is part of the CAPM model, so I don't know why they listed risk premium separately. The model will be either golden growth model, or it can be because golden growth model is constant dividend growth model, meaning dividend is growing at a constant rate. But what if dividend is not growing at a constant rate? We have to use variable growth model. And what if the company doesn't pay dividend? And we have to use free cash flow model, right? So we'll find cost of common stock. It's not the stock price, but we're trying to find the cost of equity, right? So there are 3 ways we can find cost of equity. And then another thing is cost of new common equity include sources of new common equity includes, because first of all, you will use, to raise new capital, you will use bond. You will use basically bond first, because bond or debt is the cheapest source of capital. Remember, cost of debt is the lowest of all 3, right? And then cost of preferred stock. So you will use debt first, and then if you still need more, then you sell preferred stock. Okay, and then if you still need to raise more capital, then finally you go to equity. But then think about it. Equity is there are 2 sources of equity, 2 sources of common stock. Why? Well, think about it. I have, talked about this before. So the end of the, I should have, let me erase. Let me erase. So then think about it. The income statement again. So after paying taxes, right? After paying taxes, then what do you arrive at? EAT, earnings after taxes, which is, of course, net profit, also called net income, right? But then um, from this, you can pay out dividends. You can pay out dividends. Of course, dividends can be equal to zero, right? That is greater than zero, positive. You can pay out some dividend or equal to zero. That means, no dividend. Now, and then after paying out dividends, whatever is left is called what? Anybody? After paying out dividends, whatever is left, it's called what? Hmm? Anybody? Are you there? I have only now down to like 5 people.
I'm here, Professor. I had to step out for a minute, but I'm back.
Okay. So what is did you hear my question then? Did you hear my question?
No, I just had an interview, but I just got back, so I didn't hear a question. Sorry.
Okay, my question is so then anybody heard my question? Huh? There are so
Yeah,
almost
you
everybody.
said after dividend, what is left?
Yeah, yeah. Okay, after paying out dividend, yeah, you heard me. So can anybody answer that? After paying out dividend, whatever is left, what is that called? After paying out dividend? Hmm?
Plowback? Is
No,
it?
no, no, no. Yeah, yeah. It gets plowed back eventually, but it gets plowed back. That's correct. But it may not get plowed back, right? It may not get plowed back. They don't always plow back. It depends on whether, but what do they plow back?
It's some
What do they?
type of earning. I'm trying to remember. It's some type of earnings. I'm trying to
Yeah,
remember.
it's earnings after taxes. So they pay out dividends. Dividend can be positive or zero, right? So
Right.
if dividend is zero, then the whole thing, EAT, is then left. And what is that
Retained
called?
earnings?
Huh?
Yeah,
Say it again?
The retained
earning
earnings?
after taxes.
Yes, yes.
Or within
Retained
earning.
earnings. Retained earning. Earnings after taxes is this. This is earnings after retained earning. So yeah, if you pay no dividend, right? This is exactly EAT if you paid no dividend, right? And the retained earnings will be plowed back. But I told you, not all the time. Why? The company will plow it, oh, they will plow back the retained earnings if the company needs capital to reinvest the capital to grow, right? They are reinvesting, plowback means reinvesting this back to themselves for capital projects. And the capital project, they need capital. They have capital projects because that is for expansion. That's to grow, right? They are reinvesting. They are plowing back to their own growth. But if the company doesn't have any capital projects, they don't they don't plow it back. They just retain it, and then it's going to be a burden if they retain it because it's better to just pay out to the stockholders as dividends, but the point is, I left the window open for a while. It's getting cold. Where was I? If the company has growth potential, if the company's growth potential, in other words, company's growth rate, in other words, how do they decide whether to plow back or not? It's simple. Look, two possibilities. Growth rate of this particular company is greater than the growth rate of the overall market. Then you plow back. But if it is not, yeah. But if it is otherwise, I don't. If the growth rate of this company is less than the average growth rate of the market, then they won't plow back. They would rather put that money into the market, right? Meaning they will put it into other, companies, so that they will get a higher return. So usually the mature companies generally don't grow. So mature companies choose to pay out all of its retained earnings as dividends, or they would put it into a fast-growing company like Tesla, and then maximize their return, right? But the point is, we want to, if the company has a capital project, that means the company is in this situation. If the company has capital project, companies, then what would they do? The company will use this retained earnings for that capital project. In other words, they plow back, right? If this is the case, the company will. So back to this. Where is it? That's why sources of new common equity include retained earnings, right? Sources of new common equity, retained earnings, right? Retained earnings first, or they have to sell new stock. Obviously, selling new stock will have that issue of flotation cost. If they use retained earnings, there's no flotation cost issue. Okay. So retained earnings however, retained earnings are not free, because look, that's what I'm saying. Retained earnings must at least earn its own cost of equity. In other words, it has to meet these two criteria. First, their retained the cost of, if their own growth rate is greater than the market, yeah, they will. And then, so at least the retained earnings must meet right, their cost of equity, right? In other words, it must. What I'm saying is, I should have put it the other way around. Their growth rate, the growth rate from the retained earnings must meet at least their cost of equity, which must be greater than the growth rate of the general market in general, right? Makes sense. So it's reinvested earnings belong to stockholders. Yeah, because it's stockholders' money, basically. So stockholders could have spent it if paid as dividends. Yes. In other words, think about it. If the stockholders, if the growth rate of the retained earnings, in other words, the return from the retained earnings is less than the growth rate of the market in general, it's better for the stockholders to get this paid out as dividend, and they would put it into the market and earn, right, better return themselves, right? It's not for free. Retained earnings is eventually the owner's capital, the stockholders. So for them, for the owners, it has to at least meet the company's cost of equity, and that better be greater than the market in general, the return on the market in general, right? Otherwise, that's what it means. Otherwise, it's better. So stockholders are entitled to a return on this firm, on these funds, right? Stockholders are entitled to a return on these funds. Therefore, there exists a cost of there exists a cost to return on equity as capital. So it must meet at least the company's cost of equity. The raw one without before adjusting. Come on, what was that?
Sorry, I'm late, Professor. Didn't.
Okay. All right. That was Louis. Well, I'm glad at least you made it. I'm glad, I mean, looking at the positive side. It's already 11:37, so it's about time to take our last break. But let me wrap this up before we. So here, where was I? So no adjustments to return on retained earnings is necessary to calculate. In other words, I already said it. You need at least a cost of equity, right, to use the retained earnings. So let's take a 10-minute break, right? It's 11:38, so we come back at reconvene at 11:50. Okay, reconvene at 11:50. Okay, all righty.
Professor, are we back?
No, I don't think so.
I'm sorry. We're back. Yes, and I didn't realize that my microphone was off all this time. So Jesus, I've been talking all this time just to myself. Sorry about that.
Yeah, I saw the cursor moving, but I wasn't sure if we were back or not.
Yeah. And I was talking all about this. And nothing was captured on the video. All my, I mean, you have the video, but no audio. Okay, so what can I say? I mean, maybe it was better that way because I was talking about why they didn't, uh, uh, why didn't, the variants, COVID, variants, why didn't they? So almost for, almost 15 minutes, the audio was off. Okay. So beta, okay, so back to the example. So I have to assume that you all learned CAPM in FNB 100, and basically, in this example, we find, cost of equity using CAPM, and because the company's beta is 1.8, and the treasury bill is yielding 6.5. So plugging that into this formula, right? 6.5 plus 12 minus 6.5, which is the 12 is the market return, times 1.8, we come to 16.4. So we use this as cost of equity for retained earnings. We cannot use this for new capital, new common stock, raising capital through new common stock because there's flotation costs. So we will need to make adjustment for flotation cost later. The second method is, solving the golden growth model solving this equation for K. Okay, so again, this is not an absolute thing. Why? Because we cannot assume always constant growth. Okay, remember, stock valuation models, there are 4 models, right? First one is constant dividend model, or constant dividend means, zero growth. We already know this because for preferred stock, we use this model, which is called the perpetuity model, right? If it is paying constant dividend, it's a perpetuity, right? Constant, and it grows at 0 growth rate. So, I mean, I spoke all that time, but nothing was captured on the video, because there was no audio, my microphone. So it cannot be made up, huh? So we use this already for a preferred stock, right? So the formula is, in that case, how you find the price. It's the dividend or R. We used it already. And then second model is constant growth model. Which is also called Gordon growth model. Gordon growth model. And we are assuming, that means we are assuming that the stock grows at a constant rate. But if a company is a fast growing company, growth firms, we cannot use this for growth firms. This can be used for a company that is, somewhere between startup and mature company. In other words, fast growing company will go through different phases of growth. So we cannot use this for fast growing company, nor can we use this for mature company, because mature companies do not grow, right? Mature companies have almost zero growth. That's why they are mature. That's why they are. So only. Okay. And golden growth model is basically dividend at time t plus 1 over r minus g. Okay. And then third model is variable growth model. Again, then it is hard to put this into one equation, but there will be different stages of growth. Early on fast growth, and then steady growth or constant growth, and then it goes into zero growth, and then when the company is in decline, then the growth rate will be even negative. But it's not. We are not interested in investing in a company that's in decline, so that will be a relevant range of growth. Or we're not interested in a company. We're not interested in investing in a company that doesn't grow. So the two relevant phases of growth would be fast growth and constant growth. So we would use variable growth model for valuing such a company, and then free cash flow model. Right? This is a model that is suitable for the company that doesn't pay any dividend, because all of these models, basically all of the stock valuation models are discounted cash flow model, even including this, right? Discounted cash flow model. But these are specifically, these three are DDM, right? Dividend discount model. So if the company doesn't pay out dividend, how can you value it? Well, you'll have to use free cash flow model, and there is no dividend. Okay. So that's why I'm saying this is still a very restrictive assumption, because we are assuming that the company is paying dividend and company is growing at a constant rate. So golden model is applicable. But what if the company isn't growing at a constant rate? We cannot use that. Of course, then in that case, we can fall back on this CAPM, or we can fall back on risk premium approach. So then mathematically, we simply rearrange this and solve it for K, and we can do that, right? We don't have much time, so I'm not gonna go over, it's just algebra, right? You multiply both sides by, the denominator, ke minus g, k minus g, k minus g. This right-hand side will be just dividend at time 0 times 1 plus growth rate. Then there will be dividend at time 1, right? Time t plus 1. So then, you will divide both sides then by p0, then you get this. And then, move the g to the other side. And then, so here, Periwinkle paid a dividend of $1.65 last year, and stock is currently selling $33.60 a share. The company is expected to grow at 7.5 indefinitely. This is a very restrictive assumption. How can you expect it to? How can any company grow at a constant rate indefinitely? But we have to estimate the firm's cost of retained earnings. Just plug in those numbers and come to, right? And then risk premium approach is basically this is like the rule of thumb, and experienced managers would have these, sort of like rule of thumb. If the project is high risk, we add like 20%. It's so to the cost of that. So it's incremental risk premium between KD and KE is similar for high risk and low risk firms. So cost of debt, we add risk premiums to cost of debt. So the cost of equity can be estimated by adding 3 to 5% points to cost of debt. So if risk premium is equal to additional risk premium on equity is equal to additional risk premium. Yeah, that's additional risk premium on equity. So cost of equity is cost of debt plus risk premium on equity, somewhere between 3 to 5%. Low risk, if the company or the project is low risk, you add 3%. Average risk, 4%. High risk, 5%. So Carter Company's long-term bonds are currently yielding 12%. Estimate Carter's cost of retained earnings. Well, using the middle of the road, 4% for incremental risk premium, and the cost of retained earnings, cost of equity, right? Using when you, as I said, you can first you will use retained earnings, and if you're still lacking funds to capital to fund your project, then you will have to sell new stocks. If you sell new stocks, you will need to make adjustment for flotation cost. But if the new project can be funded by the retained earnings, we simply use unadjusted cost of equity. But then using risk premium method, you will add risk premium to the cost of debt. So 12 plus 4%, 16%. Okay, and all of these examples use different companies. So if we use the same company example, right, we can compare which one under each method, which one gives but of course which one gives what rate, but that doesn't necessarily mean the lowest one is the best, okay, or the highest one is the best. But I would say CAPM will give you the most reliable. CAPM will give the most, rather than reliable, but most accurate, most risk-adjusted cost of capital, cost of equity. Okay. So we have another. Then we have to talk about cost of new common stock. It's just making a adjustment for flotation cost, and that we cannot do it today because we are almost out of time. We're already out of time. So, are there any questions so far? Any questions?
No
Any questions?
No.
All righty. So, all right. I will take it as no for the everyone. I said to I will assume that you spoke for the entire class.
Professor,
Yeah, yeah.
what is like the topics that is gonna be on the final? Is it gonna be cumulative or is just the last like topics on the course material?
Yeah, it's the last. It will be the last topics on the. Will be, it will be all
So it's not
broken
going to
up
be
like
on the
this.
other topics that we had prior tests on?
What? No, no.
It's
Look,
not going to be on the other topics that we had past tests on?
no, no. I'm breaking up. I'm breaking the exams up by the topic. So at least that's why I give 4 exams, so that the burden will be minimal. So we did, I think. Quiz 2 was
Professor.
on like. Hold on. Quiz 2 was on topic 2 and topic 3, I believe. Quiz 2 was topic 3 and topic 4. Quiz 2 was on topic 3 and topic 4. So the final will be on topic 5 and topic 6. Okay? All right?
Okay, got it. Thank you.
All righty. So if there
The grade tests on Blackboard, are those updated grades?
Yes. Yes. You mean this? This? Yes. That's the most up to date. Okay?
Okay, so is it possible I can step back after class so you can go over my grade with me?
Yeah, sure. Yeah.
Okay.
All righty.
Does the grade now include participation?
Yes. I'm gonna. So, okay. Let's talk about it. You may be excused now, but if you are interested in learning more about, let me. I have already, I have that file here already. So, look. Take a look at your attendance. And this is, participation points. Of course, this is attendance and participation points. This is, attendance and participation points. And so your weighted average is 20% quiz 1, 20% midterm, right? 25% quiz 2, 25% final. But final data still has to come in. We don't have final. So based on only this and the attendance and participation, right? Right. So here, this person, this is sorted in descending order of weighted average. So this person is actually row 8 here, right? Okay.
All right. Thank you, Professor. Have a great day.
You're welcome. So, Tyra, did you find your? What is your?
Yeah, I'm about to look for it right now.
No. Give me your student ID. I'll
Okay,
look
give
it
me
up.
1 second, Professor. Okay, give me 1 second. I'm coming. It is 23.
23. Hold on, give me a second. 23.
27. Wait, 2376.
Say that again. 23, 27.
No, 2376.
76. 23, 76 and
8110.
8110. Okay.
Mhm.
So here it is.
Okay.
So your weighted average is this. It's a good thing. You are like you're above the mean
That's a
and
B
the
plus.
standard. I don't know yet. Let me see. So the standard deviation is like 14. So that means if you about one standard deviation above mean, which will be like 53, right? 53
Yeah.
is like the 53 is like the cutoff line for A minus, just as a rule of thumb. One standard
So I have an
deviation
A
above.
minus in the class.
About not well for now. For now, if was this you? Is this you? Where were you?
No. Up. I think number 7. Let me do it again. 23,
Okay.
76.
Oh yeah,
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 7.
yeah. So then, yeah, you are safely in currently like A minus bracket, but then we don't know yet. That's not definitive, right? Because we still need the
Okay, so
final.
before
When
the
the final
final.
comes
Okay,
in,
before the final. So I have an A.
yeah,
I have an
so
A
what?
minus.
Yeah, but it will all change because when the final comes in, weighted averages will change, and the mean of the
Uh-huh.
weighted average and the standard deviation of the weighted average will also change. Okay.
Okay, so I have a question. So
Mhm.
if I get like a 85, between 85 and a 95 on the finals, that will it will leave my overall.
Well, still, I don't know because then I can't tell but if you get 85, I mean there's a big wide margin between 85 and 95, but if you get 95, chances are you will pretty much maintain A minus or better. At least you will maintain A minus, but if you get 85, we don't know. We don't know. I don't know yet because once again, the weighted average will all change depending on how people do,
Okay, Professor,
right?
thank you.
The
I
mean
understand.
of the weighted average will be different.
Yeah.
It will change. Standard deviation will be different, and then your place, your rank will be it's relative. So it's relative to mean and standard deviation. So um, it cannot be guaranteed. Okay. There's no guarantee, right? So you just need
Okay.
to do well.
Okay.
Okay? All right?
Yeah.
Give it your best shot. All right?
Okay.
All right, so
Yeah.
okay, that's it for today.
Okay.
That's it
And
for today. All righty. I'll see you guys all on face-to-face day, hopefully. Okay? All righty. I'll stop
okay,
sharing.
Professor, thank you so much.
All right. Take care. Have a great afternoon. And stop sharing and sign out.